Okay, so welcome to Accounting 232. In this course, we're going to change the focus from what we were mostly concerned about in Accounting 231, which was the financial accounting rules. And in this course, we're going to be primarily concerned with the managerial accounting rules. So as we go through this, we'll touch on some of the main differences between the two types. But for now, we'll just jump right in to different sources of accounting information. So what we see in this first question is really this idea of comparing, well, what is financial accounting? What is managerial accounting? So as we go through these, we'll kind of talk about why each one of these might be closer aligned with one or the other. So the very first one here tells us we're trying to determine whether to lend to a company. So in that case, we're really looking at their financial statements. We're trying to decide, do we think they are stable financially? Do we think they're going to be able to repay this? So that is obviously a use of financial accounting information. The next one here tells us that we are trying to evaluate a purchasing department's performance. So notice here, we're not looking at the entire organization like we might with financial accounting, but instead we are looking at only one department. So that's how we're going to know this is a managerial issue. Next, we see that we want to report financial performance to the board of directors. Well, when we go before the board and we're reporting that financial information, that is in regard to the entire organization, and that is a financial aspect of accounting. Next, we want to estimate the product cost for a new line of shoes. And in this case, that will be managerial. We'll be seeing the term product cost quite a bit in this video, but you probably haven't seen it before. That's all right. But that is going to be managerial, and we are looking at that one specific item, that line of shoes. Next, we want to plan the budget for the next quarter. This is also a managerial accounting type of function. Next, to measure the profitability of an individual store. To measure the profitability of that individual store, that will also be a managerial issue. Next, we see that we need to prepare financial reports according to GAAP. So according to GAAP, that is financial. GAAP is who makes the rules for all of our financial accounting, but we get away from the GAAP rules here in managerial. Next, we want to determine the location and size for a new plant. That is managerial as well. So that brings us through to the end of that question. So hopefully that one makes some sense. Hopefully you're able to figure that one out. But if not, we'll go ahead and talk as we zoom out just a little bit about the generalized differences in the two types of accounting that we've seen so far in the last course and in this course. So typically your financial accounting is going to be based on a focus of providing information to those external users. So we're looking at lenders, we're looking at shareholders, we're looking at all those types of people who are making financial decisions based on the information they've been provided. It's also going to be controlled by what is called US GAAP, which is what we just talked about a second ago as being the rule makers for all of your financial accounting. Now, in managerial, we don't have that focus on US GAAP. So the very next thing that we want to talk about then is, well, does this information need to be audited? For financial accounting, yes, we get an annual audit at the end of the year. We'll have auditors come in, look through our books and records, and try to make sure we have reported everything properly. And in managerial accounting, that is not required. Typically, for financial accounting, our focus is on the entire organization, whereas for managerial, it is typically based on a small area, an individual unit, process, division, something along those lines. And the last thing here really is the focus as far as time. So with financial accounting, we are typically focused on the past with few predictions. However, with managerial accounting, we're focused on the future with many projections. What this tells us then is financial accounting is often set in stone. This is what happened. We know that's what happened, so here it is. Managerial accounting, on the other hand, does the opposite, and it says, let's plan for the future. Let's see what's happening, and we're going to make those adjustments as we move along. So it's two different focuses for the two different types of accounting. Now, the very next thing that we want to look at then is exercise 14-2. So here what we're seeing is we're trying to determine a couple of things. We're trying to determine first, do we have a variable cost or a fixed cost? And is that a direct cost or an indirect cost? So these are terms we're going to be seeing popping up all throughout the rest of the semester. So let's take some time now, really get acquainted with what they mean in the context of this course. So you may have heard about fixed and variable costs in the past, and that is fantastic if you have. But I do want to take just a second to review them with you. So variable costs, these are going to be costs that change in proportion to changes in volume. So as you produce more basketball goals, you will need more materials to build the rim, to build the backboard, to build all the different pieces. As you produce more shoes, you'll need more leather, more stuff to make the shoelaces, all of those types of things. So you get the idea. Those costs are variable. You also need more hours for your employees to put those projects together, to produce those items. All of that is variable. Now, a fixed cost is a cost that does not change with changes in volume of activity. So what this tells me is these are going to be the costs that stay the same whether I produce 1 unit, 1,000,000 units, or no units. It makes no difference within what we call the relevant range. This relevant range tells us that while some costs are fixed, they are only fixed to a certain extent. While my factory rent may be fixed in total, so say $10,000 a month is what I'm paying to rent the space that my factory is using. But if I need to get a larger factory, then that rent cost will still be fixed, but it will be at a new higher level. So we'll see that happen as we move through the semester. But for now, there are certain costs that do stay fixed. Things like rent, insurance, property taxes, supervisor salaries. All right, if you see the word salary, it's typically fixed. If you see the word wage or an hourly rate, all those types of items would then be variable. So we have discussed those items. The next area that we want to talk about briefly is this idea of a direct cost versus an indirect cost. So a direct cost is what we say can be traced to an individual cost object. And while everything can be traced eventually, what is the key here is that this is easily and cost effectively. I could absolutely trace how much glue I put into every single product, but if glue is a small component of that product, it's probably not worth my time. Instead, I'll look at something using variance analysis that we'll get to later in the semester that'll help me figure out where I'm using my money and where my resources are going. But it might not make sense to try to track down exactly the cost of the glue in each pair of whatever product you are producing. Now the next item here talks about these indirect costs, and these indirect costs are costs that cannot be traced to an individual cost object easily and cost effectively. So this is where we realize that while we probably could figure out exactly how much that nail cost to put together this decking for a client, it might not make the most sense to do that because the time we're going to spend to figure out the cost of that batch of nails is probably worth more than figuring out exactly which nails we used. So we probably don't want to do that unless those nails, of course, are a significant expense, and then you might have a different view on it. But assuming they're a very insignificant portion of the overall cost, you probably would not want to waste the time doing that. So now we'll look here at exercise 2 and see if we can use what we just talked about to figure out the answers to these questions. So the very first thing here is they want us to determine whether leather covers for soccer balls is a variable cost or a fixed cost, and then we'll say whether that is direct or indirect. So let's think. If I produce more soccer balls, will I need more leather? And the answer, of course, is yes, because that cost is going to increase as my production increases. This is a variable cost. Now, can the cost of that leather be efficiently and cost effectively traced back to that individual soccer ball? Absolutely. If we're producing soccer balls, that leather is a very important piece of that, so we definitely want to make sure we know exactly how much leather is going into each one of those. Now the next one here tells us an annual flat fee paid for office security. So it is a flat fee, which means it's not going to change, which makes this a fixed cost. Now, is that necessary to producing our products? Probably so. All right, we have to make sure we are able to maintain security at our offices, but it is not directly traceable to each individual soccer ball, for example. So that would be an indirect cost. Next, we have coolants for machinery. Assuming we maintain these on some kind of cycle and there's not a whole lot of variation, this is going to be a fixed cost. This is also indirect, as there's no way to assign that cost of coolant to each individual soccer ball, at least not cost effectively. Next, wages of assembly workers. This is definitely variable, as the more time they work, the more they get paid. However, this is directly traceable to that product, so this is a direct cost. Next, we see thread to hold the leather together. This is absolutely a variable cost, as the more soccer balls we produce, the more thread we will need to hold that together. But this is most likely a very inexpensive portion of this soccer ball, so this is an indirect cost. It simply wouldn't make sense for us to try to track down exactly how much thread got used on each one of these soccer balls. Next, we got taxes on the factory. Well, taxes are typically fixed. And even if you say, well, factory taxes change year over year, correct, they most likely will. They most likely will increase. But remember, in this course, what we mean by fixed is not necessarily that it stays the same over time, but instead that the volume does not impact the cost. So your property taxes are not based on how many soccer balls you produce, but rather on the property itself. So that is why this is a fixed cost, even though in your head you may say, well, that's going to change over time. Absolutely it will. But just make sure you understand what we mean in this course is, does that cost change proportionally to changes in activity? Property taxes do not, so that is a fixed cost. Next, that will be indirect, because we will not try to assign the cost of those property taxes to each individual soccer ball. Next, we see here machinery depreciation, and they do tell us this is straight line. Because it is straight line depreciation, that is a fixed cost, and once again, it is indirect. Now, the way that you could have machinery depreciation be variable is if you used what we call activity-based depreciation. So then it would be based on the number of soccer balls you produce. At that point, you would have a variable cost. In this case, we do have straight line depreciation, so that is in fact fixed, as the value will not change with changes in production. So that wraps up the first two questions for us on this homework assignment. So we will move on to number 3 and 4. So here with number 3, what they're asking us to do is to identify different types of costs, once again as variable or fixed and as direct or indirect. But in this case, this is for a service company. In the last example, it was not. So we'll see a little bit different items in this question. So the very first thing is advertising. So once again, similarly to property taxes, I don't want you to think, well, we may vary the amount of advertising that we do as the year goes on. We may advertise a lot more around Christmas and major holidays. We may advertise a lot less during the lower periods where we just know we're not going to see that return. That is true, but that does not make this a variable cost, because what we mean by variable, once again, is that the changes in activity level will drive the change in cost. That is not the case. Us simply producing more items is not going to drive up advertising. So instead, this advertising cost is fixed and is an indirect cost. Next, we see beverages that are served on a plane. These beverages will be a variable cost, and that will be direct, because as we have more passengers on the plane, as we use more flights, we will serve more beverages. But we should also be able to track how much those beverages are costing for each individual flight pretty easily, so that is a direct cost. Next, we see here the regional vice president's salary. So because this is a salary, that tells us that we are dealing with a fixed cost. This is indirect, as we cannot assign his salary or her salary directly to an individual product. Next, we see here depreciation, once again, straight line on ground equipment. This is once again a fixed cost and is indirect. Next, we see fuel used in planes. So as we use more flights, we will see an increase in fuel cost. So we do see that that is a variable cost. Now, the next thing that we want to determine is that direct or indirect? Of course, that is direct. We can easily track the amount of fuel that is used for each flight. Flight attendant wages. So because we see the word wages here, that tells us we are dealing with a variable cost. So we see that that is variable, similarly to everything else on this flight. If it is on the plane and we can easily track it, that is direct. Now, pilot wages, very similar to the flight attendant. They, in fact, the exact same for our purposes. Next, we see the aircraft maintenance manager salary. Well, once again, we see the word salary, so we know that is a fixed cost. And because it is the maintenance manager, it is indirect. We aren't going to assign his cost to each individual flight. It just doesn't make sense. So that is an indirect cost. Now, this next question asks us to classify what we call the manufacturing costs. So here we have our manufacturing costs. They are also often called the product costs. So what we are going to do is work through this together. So in the first one here, it tells us to identify what is a display screen. Well, that display screen, as you are making different iPhones, is going to be a direct material. So direct material, if you look down at the bottom, is the tangible components of a finished product. So these are the parts that go into making that product complete. So the screen is a very important part of a phone, and so that will be a direct material. Now, the next thing down here is the idea of direct labor. Now, this is the employees who physically convert materials to the finished products. So what this tells me then is that this is when we are dealing with the employees who actually have their hands on the components putting together that phone. However, what about our supervisors? What about our maintenance workers? What about our CEOs and all of those types of people? They're all important, but they're not the ones making the products, so they are not part of direct labor. The next area that we see as our manufacturing cost or our product cost is factory overhead. The basic rule here is if it's not direct materials or direct labor and it's involved in manufacturing, it is factory overhead. So you say, well, what on earth could this be? This includes items like indirect materials. So we're talking screws, glue, nuts, nails, etc. Indirect labor. These are our supervisors, maintenance workers, different people along those lines. We've got factory utilities, factory rent, depreciation on factory buildings and equipment, factory accounting, legal services. All of these items fall into this factory overhead component. So make sure you're very familiar with them. Now, the next thing is if you're not one of these three items, then you're what we call a non-manufacturing cost. These are also called period costs, and these get expensed when incurred. Now, while we're here, I'm going to just take a second to point out that these actually get capitalized and eventually expensed. So it's a little bit different timing on the expense recognition, which is why this is so important. So these manufacturing costs will actually be capitalized and go to inventory when they are produced, and they will eventually be expensed through cost of goods sold when they're actually sold. So it will eventually make its way over to the income statement as we saw in Accounting 231, but not immediately. Immediately, those costs go to inventory, while these non-manufacturing costs, these period costs, are expensed immediately. So now within these non-manufacturing costs, we do have two major groupings. We have what we call selling expenses, and then we have general and administrative expenses. So selling expenses are costs incurred to sell the product once it is completed. This includes things such as advertising, delivery, commissions for salespeople. Anything along these lines is a selling expense. Next, we have general and administrative, and these are costs that are not related to the manufacturing or sale of the product. This includes accounting, office employee wages, office rent, office equipment depreciation, etc. Now notice, there are some similarities here. Up in factory overhead, I told you things like depreciation on factory buildings. Now I'm telling you office equipment depreciation is a non-manufacturing cost. You have to be very careful and make sure you understand, is this depreciation happening on a factory building, or is it happening on office equipment? Or is it happening on those factory pieces of equipment? It depends. If it's related to the factory, it's factory overhead. If it's not related to the factory, it is a general and administrative expense. So do make sure you realize that. Also, we point out here that accounting was listed as a factory overhead item, but notice this is factory accounting. Whereas down here, we've got your just more general office-based accounting. So you have to be very careful. So you understand these items could go either as a manufacturing cost or a period cost, simply depending on what they are related to specifically. So do make sure you slow down and read to make sure you get these questions correct. Okay, the next one that we have, just resuming our listing down here, is these assembly line supervisor salaries. Well, that is going to be part of factory overhead. So here they told me to use FO for factory overhead, so I am. Typically, the more common abbreviation is FOH. So I may abbreviate with FOH, but this question specifically asks for FO, so I'm going to use that. Next, wages for assembly line workers. Well, these assembly line workers are the people actually putting together the phones, so that will be direct labor. Salary of the chief executive officer. So the salary of the chief executive officer is going to be a general and administrative expense. They are not down on the floor putting together these phones. Instead, they're managing the organization. Next, glue to hold iPhone cases together. So we've got the glue here for number 5. This will be factory overhead. More specifically, this is indirect materials. Next, we have uniforms provided for each factory worker. Once again, this is factory overhead. Wages for retail store workers. So these are the people actually selling our products. These are selling expenses. And finally, depreciation, straight line, once again, on robotic equipment used in assembly. So if it is used in the assembly of these phones, then that will be factory overhead. So that wraps up questions 3 and 4. So now we'll move on to question number 5. And here with question number 5, what we want to look at, once again, is this idea of direct or indirect, product or period, what type, if it's a product, is it direct material, direct labor, or factory overhead, and if it is a product cost, is it a prime cost or is it a conversion cost? So we've got quite a few levels to this question, so we'll walk through each one individually. But before we do, I want to touch on the items we have not yet talked about. So on previous questions, we have talked about direct, indirect, product, period, direct materials, direct labor, and overhead, but we have not talked about this idea of prime costs or conversion costs. So prime costs, these are the costs that are going to be directly associated with the production of finished goods. To find our total prime cost, we simply take direct materials plus direct labor. That is a very important formula you will need to know from now until the end of the semester. So I'm going to write it down here just so it stands out. So prime costs equal direct materials plus direct labor. Next, we want to talk about this idea of conversion costs. And these are the costs incurred in the process of converting raw materials to finished goods. To find total conversion costs, we take direct labor plus factory overhead. Now, do be very, very careful. One of the most common things I see people do is when they try to get conversion cost, they get lazy. They've already calculated prime costs and they just add on factory overhead. Do you see a problem with that? I certainly do. Your direct labor is included in both, but direct materials is not part of conversion costs. So it creates all kinds of issues. Do not do that. Instead, take the time. They're not difficult formulas. It's just adding two numbers. Do them separately and you will get the right answers. Don't try to take shortcuts. It will lead you to an incorrect answer. So there you go. So that's all we've got here, prime cost, conversion costs. So now we'll walk through each one of these items. So factory electricity, this is an indirect cost because we cannot track the amount of electricity that goes to producing each individual product. So the very next one, or the next part of this, is if it is an indirect cost and it is related to that factory electricity, is that a product cost or a period cost? And this is in fact a product cost. Next, since it is a product cost, is it direct materials, direct labor, or factory overhead? This is factory overhead, and factory overhead, if we look down here, is that a prime cost or a conversion cost? That is a conversion cost. So we've got the first one done. Next, advertising. Is advertising direct or indirect? In this case, neither. We don't trace it at all. And because in this table, what we're really looking for is, are these product costs? If they're not, then we're really going to see a lot of NAs through here. So in this case, it is a period cost. It's that advertising. So we have a period cost. And because these two columns only apply if it's a product cost, then you have these two items being in A's. And so that brings you through now to this next question. So here, amortization of patents on the factory machine. So this is indirect. That is a product cost. Specifically, it is part of factory overhead because it is amortization on a factory machine patent. So if you remember back in 231, we talk about intangible assets, and intangible assets do not get depreciated, they get amortized. So it's the same type of item as depreciation, but it's just for that intangible asset that is that patent. And is that a prime cost or a conversion cost? In this case, it is a conversion cost. Next, we see batteries for electric cars. These batteries for electric cars are direct because we want to know exactly how much that battery is costing in each one of these electric cars that we put together. That is going to be a product cost as it is directly associated with the product itself. More specifically, that is a direct material, and direct materials are prime costs. Next, office supplies used gives us an NA for direct or indirect. It is a period cost. Once again, an NA for the last two columns because those two columns only apply if you have a product cost. Since that is a period cost, that will not count or will not be applicable. Next, wages to assembly workers. Wages to assembly workers can absolutely be traced to the individual products, so that is a direct cost. Because it is part of producing the individual product, it is a product cost. Direct material, direct labor, or factory overhead. Well, it is the wages to the assembly workers, so these are the people on the ground doing the work, that is direct labor. So is that a prime cost or a conversion cost? Well, let's look. When I look, I see direct labor there, and I see it right there. So this is actually a prime cost and a conversion cost. So it is actually both. The direct labor is both a prime cost and a conversion cost. So with that finished, we will move on to the next question. So here in question number 6, I'm just going to recommend you take a picture of this screen for now, because the worked out problem takes up far more room than was left on this page. So you need access to these numbers, but I'm going to go ahead and go down to the next page so that we have that available for us. So for this question, what I'm going to do is I'm going to use a key. Whoops, that got much larger. So we're going to use just the letter G, and it's going to mean given, as in that information was just given to us in those facts in the table above. And I'm just going to write that as we go down through this question, just along these dotted lines. So what we're going to have to do is we're going to have to break this question up into a couple of pieces. And we're going to look at all of the different processes or the parts of how we calculate cost of goods manufactured. Well, to do that, we need to figure out which costs are manufacturing costs. And as we talked about previously in this video, we said that those manufacturing costs are made up of direct materials, direct labor, and factory overhead. So we're going to see how all this comes together in this report for us so we can get some useful information out of all of this. So this looks like a very long question. Looks like there's just a ton of moving pieces. Some of that is true. Not all of that, though. And that's why I'm going to use this letter G, just to make you realize exactly how much of this is just knowing where to put the numbers. You're not having to actually do a lot of computational stuff. It's just a matter of figuring out which numbers go where. For the sake of brevity and for keeping this video as short as possible, I will only be doing this for the Garcon company, because you will do the exact same thing for the Pepper company. So on your homework assignment, make sure you do both companies just for the practice, but for the sake of making this not take twice as long, I'm going to only do this one time. So the very first thing we want to look at here is direct materials. So beginning raw materials inventory was $7,250, and that was given. Next, we had raw material purchases, which was $33,000, which was also given. Next, we need to calculate what is called raw materials available for use, which is just the sum of those two items. So that tells me this is $40,250. Next, we need to take out the ending raw materials inventory, which was also given, for $5,300. When I do that, I see that my total direct materials used then is $34,950. Now, we have finished with direct materials. The next thing we want to look at is direct labor. They had to give us the balance for direct labor, which was $19,000. Next, we look at factory overhead, and all of this is given information all the way down until we actually have to sum it up for the total factory overhead number. But the rental cost on factory equipment per the facts, $27,000. Factory utilities per the facts, $9,000. Factory supplies used, $8,200. Indirect labor, that was $1,250. And repairs on factory equipment, $4,780. And if you add all that up, you'll come out to $50,230. Next, we have total manufacturing costs. This is just going to be the sum of my total direct materials used, direct labor, and factory overhead. When I add those three numbers up, then I will find this equals $104,180. Next, I will add in my beginning work in process inventory, which was also given, for $14,500, which gives me total cost of work in process $118,680. Next, I need to back out that ending work in process inventory. So I'm going to do that with these braces that we saw earlier, and that will be for $22,000. Now we'll finish this up with cost of goods manufactured being a total of $96,680. And you'll notice that in all of this, we only had to do a couple of computations, and most of those, or really all of those, are just basic addition and subtraction. So nothing too complicated here. We've just got to make sure we know when to use what and how it all relates. Now you'll notice we backed out that ending work in process inventory, and that's because we are trying to figure out how many goods were actually finished and how many goods were manufactured in this period. If they're still in process, they were not finished. So that explains why we do this right here. Now the next piece then is to figure out exactly how much we sold. So the very first thing we want to look at then is this beginning finished goods inventory. That balance was given to us. It was $12,000. Next we have cost of goods manufactured, and that's what we just calculated. So that's the $96,680. You add those items up and you get what is called cost of goods available for sale. So 108,680. Next, you need to back out the ending finished goods inventory, which was also given. So that amount is $17,650. When you do that subtraction, then you'll come out to cost of goods sold of $91,030. So cost of goods sold, we're basically taking beginning finished goods inventory, adding in what we made, backing out what we did not sell that's still left in that ending inventory, and that is backing us into the cost of goods sold number that we see right here. And so that brings us to the end of that question. So with that, we will move on to the next question. So number 7, we're still using the same data. We're still using the same companies. On this question, I was actually able to fit in a small snippet of the given information down here at the bottom. So do feel free to use that as you follow along if you wish, or open up the textbook, find your version of the question. However you want to do it is perfectly fine. But that brings us to this next piece where we're now calculating the prime costs and the conversion costs. So once again, we'll use the same notation where G equals given information. So anywhere you see a G, that is information you simply have to pull out of the given table. So in this case, we have beginning raw materials inventory, and as in the last question, I'll only do this company. So beginning raw materials inventory, once again, is $7,250. That is a given information. Raw materials purchases, $33,000. Raw materials available for use, $40,250. Next, we need to back out that ending raw materials inventory. This was $5,300, and that gives me total direct materials used. Total direct materials used then is $34,950. Now, if you go back to the previous question, you see that matches what we said earlier. So hopefully you see nothing has changed. We really just did the exact same thing we did on the previous question. Next, we need to add in that direct labor. Once again, that direct labor is, of course, the $19,000. And when you add those two items together for your total prime cost, you'll get $53,950 for Garcon Company's prime costs. Next, we need to do conversion costs. For conversion costs, we'll begin with the easy part, which is direct labor. It's $19,000. Next, we simply need to add up all of the items that we were given. And so this is the rental cost on factory equipment, factory utilities, factory supplies used, indirect labor, repairs on factory equipment. All of these items given to us. So here we see this is rental cost on factory equipment, $27,000, $9,000 for factory utilities, $8,200 factory supplies used, indirect labor $1,250, and repairs on factory equipment $4,780. Now when you add all those items up, what you'll find is that total factory overhead number is $50,230. Your conversion cost then is $69,230. Please notice these two are not the same. Could they maybe possibly be the same every once in a while? Absolutely. But please do not get them confused and think, oh, I can just take some kind of shortcut and go from my prime cost to my conversion cost. No, don't do that. Take the time, work them out separately, you'll get the right answer. So this has been done properly. We do feel good about this, and so now we can move on to the next piece of the homework assignment. But before we do, I just want to take a second and just show you this. Look at how many of these items were simply given to us in these questions. Yes, there's a lot of data here. Is it very complicated? Hopefully not, because all you got to do is slow down, figure out where that information goes, and drop it in there. Right? We're not doing any kind of very complex calculations. We're trying to keep this as direct as we can, but there is a lot of information we're going to have to sort through. So getting used to doing that early in the semester will help you greatly as we move through and we get into some of the more challenging areas in this class, but just not getting overwhelmed, not feeling defeated when you see this amount of information. So that brings us to the end of that series of questions, and so now we'll move on to the very next one. So here we're once again doing a cost of goods sold computation, but in this case they're going to give us the information in slightly different ways. So what I'm going to do here is I'm going to walk you through the Unimart calculation, and we'll go through precision manufacturing. So for Unimart, the way the information is given to us, we can take our merchandise inventory, in that beginning balance is $275,000. Once again, that's just given information right there. We then have merchandise purchases of $500,000. When we sum those items together, we see that cost of goods available for sale is $775,000. We then need to back out that ending inventory of $115,000 because if we still have it, it has not been sold. So if you had me for Accounting 231, you know when we talked about inventory, we basically said there were two options for your inventory. So we said you had beginning inventory plus what we called purchases. Those two items come down to give you this inventory balance. We then stated that that inventory cannot just stay there forever. It has to go to one of two places. So we said it can either go to ending inventory, which is a balance sheet account, or it can go to cost of goods sold, which is your income statement account. But it has to go somewhere. It can't just stay in this intermediate inventory position for eternity. It has to move. So it either stays on in ending inventory for the end of this period and hopefully will be sold next period, or it goes to cost of goods sold. That's it. That's all we need to know. So in this case, all we're saying is we're going to take that beginning inventory balance of $275, those merchandise purchases of $500, which gives me a balance of $775. They then tell me I've got $115 here, which means this $775 and this $115 have to come back equal. If $775 went into this middle right here, this $775 has to come out. If $115 went to the ending inventory, then the $660 must go to the cost of goods sold. I don't know if that helps you or not. If that confuses you, don't worry about it. Do it in the table. But if the visual helps you, then feel free to use that method as well. So we'll clear that out and we'll move on to the second calculation here. So what we see here then is for precision manufacturing, we have finished goods inventory beginning, and that is $450,000. So we've got our beginning. Then we had some goods that we actually manufactured. This was $900,000 worth of goods, which tells me I've got goods available for sale of $1,350,000. I then need to back out my finished goods inventory ending balance of $375,000, and that gives me cost of goods sold of $975,000. Now, the simplest way to understand this is to just write it in a formula. So take beginning inventory plus purchases or manufactured goods, right? So in the first example, we had someone who bought their inventory. In the second one, we had someone who built it, but that's the same thing as far as we're concerned. And we back out that ending inventory. That will then give us cost of goods that were actually sold during the period that will then flow through to our income statement. So that wraps up question number 8. Now the very next thing that we want to look at then is this question here for question number 9. And so I'm going to just erase this just so we get us a nice clean page here. So for question number 9, what we see then is this idea of preparing a schedule of cost of goods manufactured. So, what we're going to do here then is take the information that they have given us in this table, and we're just going to try to put it together in a useful format. So once again, we'll use the same notation of G equals given, just so we can understand exactly how much of this is just given to us to help us make more sense of this. Now very quickly then, what we need to do is break into our groups, direct materials, direct labor, and overhead, and within them we will find the accounts that are related. So what we have here then at first for this is the idea of these direct materials. So we just need to look up in our table, figure out our beginning raw materials balance of $37,000. This was given information. We then have raw materials purchases, which was also given information for $175,600, which then gives me raw materials available for use, which is just a sum of those two, which is $212,600. Next, we back out those ending raw materials in our inventory. This was also given information for $42,700, which gives me a total of $169,900 for total direct materials. Now, direct labor is our favorite one. It's typically the easiest. It's $225, and there it is. Now, factory overhead, which was also given. Factory overhead, we have factory supplies used, which was given for $17,840. Indirect labor, which was given for $47,000. Next, we see repairs on the factory equipment, which was also given, and that is for $5,250. And finally, the rent cost of the factory building, also given information, $57,000. So total factory overhead costs then are $127,090, making our total manufacturing costs $521,990. And it's just the sum of those two items and that right there, which gives you $521,990. Next, we take more given information, the work in process inventory at the beginning, which was $53,900. We add that, which gives us $575,890 for my total cost of work in process. We will then need to back out that ending work in process of $41,500, which will give me $534,390. And that wraps up the end of question number 9. So hopefully you see, once again, a lot of this information is just given to you. It's just a matter of figuring out how to make it all work together. So we will move on to question number 10. Now, I really like question number 10. A lot of people don't like it, but I like it because it gives you a very good visual depiction of exactly what's happening in this question. So I think it's a really good one to spend some time on, to just familiarize yourself with how these costs flow down the line. So what I'm going to do is, as we work through this one, I'm just going to jot down in this bottom section how I'm doing the computation, and then in the top section, I'll just write in the answer. So that way we keep this nice and clean. So for this very first item here, what I'm going to call letter A, what I'm going to do is look at all of the arrows coming into it and going out of it. Well, coming into it, I've got 532 plus 145,500, which tells me that's going to be $677,500 right there. So all that's going into that is my raw materials purchases and my beginning raw materials inventory, which tells me my raw materials available for use in production. Next, I need to figure out how much of those direct materials was actually used in production. So I look and I say, well, this $677,500 goes to two places. Part of it goes to right here and part of it goes there. So if I then take my $677,500 and I back out my $175, what I'll come out to is $502,500 that was actually used in production. Now, to calculate my total work in process, you got to be careful here. There's a lot of arrows coming from a bunch of directions, so don't accidentally miss one. So I'm going to start with the one that we just did, 502,500. Then I'm just going to add everything I see. So I see 350,000. I see 84,500. I see 750,000. Now, when I take all three of those together, I'll come out to $1,687,000. So my total work in process then is my beginning work in process plus direct labor used in production plus direct materials plus factory overhead used in production. Now the question is then, how much is left in my ending work in process inventory? So I've got this $1,687,000. Part of it goes there, part of it goes here. So if I know that $1,687,000 has to be between those two places, I can then back out the $1,593,500 and come out to my $93,500 for my ending work in process inventory. Now, to come down to the next one, this beginning finished goods inventory, what I'm going to need to do is figure out that between, let me erase some of this really quickly just so you can have a nice clean look at it. What we see is somehow there's $1,740,250 in finished goods available for sale. We only manufactured $1.6 million roughly this period. So how do I find what we began with? I just subtract $1,740,250 minus that $1,593,500, and that tells me that I end up with $146,750 for beginning finished goods inventory. Now finally, just as we've done on many of the others, I see that I've got this $1,742,50. Part of it went to ending finished goods, so how much of it went to finished goods sold, or what we would normally call cost of goods sold? Well, that's going to be my $1,742,50 minus $139,950, which will come out to be $1,600,300. So $1,600,300, and here we had $146,750. And so that wraps up this question for us. So hopefully if you go back and you study through this question, it'll make some sense to you. It does look pretty intimidating. There's a lot of stuff going on in it. It's a nice big picture, but I like the way it labels everything. I like how you can actually see that flow coming down through everything. Gives you a nice, good depiction of exactly what's happening here. So that's all we have for number 10. And with that, we'll move on to the very last question here, which is question number 11. So this chapter briefly touches on what we call lean business practices, and so that's what this homework question addresses. Is this idea of can you identify the differences between just-in-time management strategies, continuous improvement, and total quality management? So it tells us here many fast food restaurants compete on lean business practices. Match each of the following activities at a fast food restaurant with one of three lean business practices that it strives to achieve. Some activities might relate to more than one. Now, in this question, we're just going to go with the best one. You could make an argument for more than one. That's all the question is saying. But for credit on the question, we're just going to go with the one that most accurately describes the practice. So very quickly, the very first one here is courteous employees. So courteous employees, that's not about making something right away. That's not necessarily we're trying to improve. We just expect you to be courteous. So this is what we're going to call total quality management. So if you want to answer it the way they do, number one is C, right? C. But I think it just makes more sense to just call it what it is. It is total quality management. Next, food produced to order. So we're not going to produce the food until you order the food. That is what we call just in time. So we're not going to try to build up a nice large inventory. We're just going to produce it when it is needed. Next, clean tables and clean floors. Once again, that is part of TQM. We just want it to be nice in there for you. We want our employees to be kind to you. We want everything nice and clean. That is total quality management. Orders filled within 3 minutes. That is going to be just in time. It's about getting that product to the customer right when they order it and us not making it before that. So that's just in time. Standardized food making process. If we make it the same way every time, then the quality should hopefully be good. That will be another hit, another point for total quality management. And finally, new product development. This is going to be continuous improvement because this is where we are saying we want to keep getting better. And one of the ways we're going to do that is by making these new products for our customers. So that wraps up the intro to Accounting 232, the Chapter 14 homework assignment. Hopefully this has been helpful for you. Hopefully you got a lot out of it and you enjoyed it as much as you can in accounting video. But we'll move on through the semester, and as you have questions, please don't ever hesitate to reach out to me, contact me. I'm here to help you succeed. I'll do that any way I can. So good luck. Thank you.